Hello everyone, welcome back. This is chapter 4. Before getting into this, I want to explain how this is going to work. Chapter 4 is going to be slideshow based. So the lecture from yesterday about swing trading was mainly chart work. Chapter 4, of course, is going to be a slideshow. I want to remind you guys that the swing trading lecture is a side piece of chapter 4 and somewhat important to understand in order to understand chapter 4. I will try to simplify this chapter as much as possible while going through the slides. Let's get into this. I don't want to waste any time. Trading a weekly range. Tuesdays have a 70% chance of creating the high or low of the week. When you are trading a weekly range, your goal is to execute trades either at the low of the week or the high of the week. If you are executing at the low of the week, you want to be exiting at the high or near the high of the week. For example, if Tuesday has a 70% chance of creating the high or low of the week, then that means you would want to be entering near Tuesday, if not on Tuesday. There's an 81% chance that the high or low of the week forms between the Sunday open at 5 p.m. and Tuesday's London session. ICT mentions this statistic as well, and so does Romeo. I will repeat it. There is an 81% chance that the high or low of the weekly candle will form between Sunday's open and Tuesday's London session. Trading the weekly expansion. You need to be entering your trades on specific days and exiting on other specific days. The goal is to be buying below Sunday's open on Monday, Tuesday, or Wednesday when we are bullish, and closing your trade on Thursday, vice versa when bearish. This means that there is a high chance that Wednesday will create and print a classic buy or sell candle in the same direction of weekly order flow. As long as you buy below the open and sell at the open of the next day, it is considered a successful trade. Now, this last point contradicts the first statements that I've made. I said that you would want to execute a trade at the low of a week and exit near the high of a week. This last point contradicts that statement, and what it means is basically, if you enter below Sunday's open on Tuesday, which is also below Tuesday's open, you enter on a turtle soup. If you exit the trade above Tuesday's open or just at the open of Tuesday, that is a successful trade and a model in itself. This coincides with the take profits that I've mentioned to you guys, hinted at. When I tell you to take profits at the high that caused the turtle soup in a bullish scenario and in a bearish scenario, taking profits at the low that caused the turtle soup. If you do these things, you will have a much higher success rate. If you look for trades which go from the protraction, which is also known as the Judah swing, back to the open and that's all you did for the day, then you would find a lot more trades and you would be a lot more successful in catching the trades. Now, how do I simplify this for you? If you only look for trades which go from the retracement, protraction can also be known as a retracement, back to the open, and that's all you did for the day, then you would be much more successful. Have an opinion on what the markets should do, but do not decide what the market will do. Be happy with a percentage of the move. So Romeo really does preach this, and I will preach this as well. As you can see, it is quoted directly from Romeo. To have an opinion, to anticipate where price will go is very important. But you do not want to decide where the market will go. What does this mean? You do not want to be stubborn with your anticipation. You need to be agile, versatile. When price is moving in a trend where price is breaking highs and rejecting lows, and you are bullish on the higher time frame, if price breaks a low and starts rejecting highs, then the shift in market structure has now just occurred. You do not want to be bullish, you want to change to being bearish. Changing your bias is very important. A lot of beginners fall victim to being stubborn with their bias, being stubborn with their anticipation of order flow. You do not want to fall victim to this. Moving on. Variations depend on what day the PD array is hit. PD array also is a key level, which creates the weekly low or high. So there are different variations from these points that I have just mentioned. Sometimes Friday will create the low or high, etc., etc. There are variations depending on what day the key level is hit. This is very important, and I am slowing down because I need you to write this down. Variations of weekly profiles depend on what day the key level is hit. This will tell you where the weekly high or low is going to be created. Let's talk about the Wednesday model. I hinted in yesterday's lecture that I will be talking about a model in specific during the lecture today. And that model is called the Wednesday model. Okay, this is a spin-off of the Monday model, where Tuesday sweeps Monday's low or high based on CRT. And Wednesday will expand, either having a classic buy candle or a classic sell candle. We will be learning how Wednesday's candle actually functions during this time, how Wednesday's candle functions during a classic buy day and a classic sell day. This is important when trying to catch an entry on the third candle of a CRT, of a daily CRT. The 1 a.m. hourly candle creates the high of day. This is all taking place on Wednesday. Let's say, for example, Tuesday has swept Monday's high. Wednesday's opening price will cause price to go into a range, turtle soup a 15-minute range, hitting a key level at 1 a.m. and then expanding lower. The sequence here: price opens, rises into a key level during London 1 a.m. High of day is now formed. Then price will move back down to the open, expanding past it. At the 9 a.m. hourly candle, we will have a retracement, which is also known as protraction, Judah swing, and then expansion leg number 2. This is a model in itself. After 1 a.m., this is the distribution leg. Then at 9 a.m., we have protraction, also known as OTE. And then after that OTE, the second distribution leg starts. So open, trace into a key level, souping a 15-minute range at the London session, specifically 1 a.m. Distribution leg number 1, OTE protraction. This commences distribution leg number 2. So once again, open, rally, range, turtle soup at a key level, breakdown. During the breakdown, we will have a change in state of delivery on the higher time frame. The change in state of delivery on a higher time frame is a market structure shift on the lower time frame. An order block on the higher time frame is a breaker block on the lower time frame. A breaker block is exactly what signifies a market structure shift. New York OTE, and then a second leg of distribution. So let me rephrase that. Price will open, rally, range, turtle soup at a key level. So we will turtle soup the 15-minute range at a key level, and then price will break down past the open, change in state of delivery on the higher time frame, market structure shift on the lower time frame. We will have a breaker block form right here. Then at around 9 a.m. during the New York session, we will have the retracement, and then we will have the second leg of distribution. This image alone is a model. If you want to screenshot this and keep it for Wednesdays in specific. Now, not every Wednesday is a buy or sell candle. However, if you are anticipating Wednesday to form a classic buy or sell candle, daily candle, of course, this is a profile that you want to keep in mind. Price is not restricted to respecting this profile. However, if the profile plays out, you must execute it. A more detailed look into the Wednesday model. The sequence here on the left is consolidation, expansion downwards, retracement, and expansion once more. Going back to what I said in the previous slide, price will open, range, turtle soup at a key level, a 15-minute range. Distribution leg number 1, retracement, protraction, OTE, whatever you want to call it, and then distribution leg number 2. 1 a.m., turtle soup, 9 a.m., OTE. If you want to catch the first distribution leg, you will execute your trades during the London session. If you want to catch the OTE, the distribution leg number 2, then you will execute your trades during the New York AM session, specifically 9 a.m. So how would one go about trading this model? By the way, before getting into this picture is not random. These highs and lows are not random. This is a sequence that tends to perform all the time. The same way you screenshotted this. This is another screenshot, a more detailed look at how price will move. Price will open. Let's say this is a 15-minute time frame. Price will open. Move below the open, quickly expand upwards towards a key level. Range below the key level. Rejecting a high, rejecting a low, breaking through a high, previously breaking through a high, and then starting to reject both ways, highs and lows. This is a definition of a range. Rejecting highs and rejecting lows. Range created on a 15-minute time frame. Turtle soup the 15-minute range at a key level. Expansion, retracement, OTE, turtle soup in the OTE within a breaker. This is important. We have a turtle soup within the breaker. In my previous lectures and YouTube videos, I've mentioned how there will be CRTs within breakers, within the OTE, within the order block. Entry short, catching the second expansion leg. So how would we go about trading this model? Well, step 1, determine the higher time frame directional bias and narrative. Bias is where price is going, and narrative is why price should go there. So my bias here, after hitting a key level, would be bearish. I have a bearish bias. My narrative is a key level has just been hit after the fact that Tuesday swept Monday's highs. Wednesday will perform a classic sell candle after and only after a key level is hit while turtle souping a 15-minute range. That is bias and narrative. Step 2, mark the midnight opening time before midnight arrives. So the daily open on Forex is 5 p.m., 17 o'clock on a 24-hour time. However, you must mark the midnight opening time, not the 5 p.m. open. Mark a potential key level which will mark the high or low of the candle you are willing to trade. In this case, it will be the daily candle, Wednesday's daily candle. So let me rephrase. Mark a potential key level which will mark the high or low of the Wednesday's daily candle. This is the key level in this scenario. Step 4, mark the CBDR, central bank dealing range, the Asia range or the flout. Mark their standard deviations to basically help you find out where the high or low of the daily candle should occur. In my Asia range video, I explain how if you measure the Asia range with a Fibonacci and you locate the standard deviations of said range, those standard deviations will help you find an area where the high or low of the daily candle will occur. The same techniques that we used for the Asia range can be used for the CBDR and the flout. That is for you to go backtest. Step 5, wait for your pattern. And I say pattern in quotations because in reality, it is more of a profile. Wait for your pattern to form below the opening price after protraction has happened. And number 6, memorize, write down your observations. This is your journal. This is probably the most important part of your trading after execution. Journal everything. So let's take a look at a chart example here. This is Wednesday's price action. The sequence on the left side here is an open. Price opens, declines, turtle soups a low, a 15-minute low is turtle souped, and a key level is hit. Price will range and pop right back above the open before the turtle soup. And then the turtle soup will occur, hit a key level like I just said, change in state of delivery on the higher time frame, of course. This is a market structure shift on the lower time frame. Entry right here. Then we will expand above the high that caused the turtle soup. This in itself is the market structure shift. This will happen right before the OTE retracement. And then we rally. Let me re-say this. Price will open, decline, range, or pop back up above the open. Then a range low will be created, a new range low, which is the turtle soup. This happens around 1 a.m. Sometimes 3 a.m. Very important. Then a key level is hit right when the 15-minute range is swept. Change in state of delivery. Close above this candle. Change in state of delivery. Shift in market profile when this high is broken. It's the high that caused the turtle soup is broken with a close above. The OTE retracement protraction will occur around that time. Deep retracement, fooling everybody out. If they went long, they got stopped out. And then we have a rally. Distribution leg number 2. A shift in market profile. This is when price will go from rejecting highs and breaking lows to rejecting lows and breaking highs. As soon as price breaks the high that rejected a low, breaking a high that rejected a low, low rejected, high broken, we see the market profile shift, also known as a market structure shift. As soon as we see price break the high, we can assume a deep retracement, this is known as the OTE, is incoming, which happens right here. This scares everybody out, and the second leg then begins. Recognize the CRT during the OTE right here. I am pointing it out again so you don't forget to study it. The market's function is to trip as many positions as they can, leading 95% of traders to be offside. So let's explain this chart here. Price opens, consolidates, we create a range, we move lower. Then price expands up, distribution leg number 1, retracement, protraction, OTE, expansion leg number 2. This, I didn't want to point this out here, but this sequence where price will open, move higher, move lower below the open, back above the open, turtle souping the high that was created right after the open, and then moving lower below the open, turtle souping a 15-minute range low, hitting a key level. This in itself is a sequence that you can use to enter an entry model. So here is a lower time frame of the exact same image that we just looked at. Lower time frame, I want to explain to you that price went from breaking lows and rejecting highs to breaking highs and rejecting lows. All right, this is midnight of Tuesday. Wednesday's candle right here. Price is rejecting highs and breaking through lows. As soon as price turtle soups a 15-minute range, this right here is the 15-minute range that occurred before 12 a.m., after 5 p.m. Important, very important to understand. Then at 12 a.m.'s open, we turtle soup the 15-minute range below the candles open, below the 5 p.m. open. Turtle soup the 15-minute range, hitting a key level that is not drawn out here. We turtle soup around 1 a.m., maybe 3 a.m. as well. Expansion leg number 1, we start breaking highs and rejecting lows. Rejecting a low, breaking highs. Now, where does the market structure shift occur? This right here is the change in state of delivery. This right here is the market structure shift. As soon as the market structure shifts with a break above the high that caused the turtle soup, break above this high that caused the turtle soup, we can now confirm the market profile has changed. Then the retracement, deep retracement OTE, entry, where do we enter? Turtle souping another range into an imbalance. That imbalance could be an order block, a breaker, or a fair value gap. Entry around 9. Expansion leg number 2 begins. I want to point something out here. The change in state of delivery on a higher time frame right here is a market structure shift on a lower time frame right here. So the higher time frame's market profile shift happens right here. The real market structure shift. The lower time frame market structure shift that occurred when the higher time frame change in state of delivery happened was right over here. The high that caused the turtle soup was broken. Market structure shift. Let's expand on our understanding of the protraction and expansion legs. First off, the expansion will happen between 1 a.m. and 5 a.m. Expansion number 1. Expansion leg number 2 will occur anywhere from 9 a.m. up until 12 a.m. 12 p.m. lunchtime. This is important to understand, as you do not want to hold your trade for too long if you are moving your stop losses to break even. So what would happen is an entry around 1 a.m. short. You move your stop losses with your position. You would get stopped out on the OTE, as this OTE will likely be a deep retracement. So once again, I will repeat it. Price opens. This is 12 o'clock's open. Previous open is 5 p.m. So the real daily open is 5 p.m. The open we focus on is 12 a.m. Price opens, protraction above a 15-minute high, tapping into a key level, then expansion leg number 1, then a second retracement, OTE, and then expansion leg number 2. The OTE, optimal trade entry, means that a predetermined swing high will form within the daily candle, smacking into the 1 a.m. candle. This right here, smacking into the 1 a.m. candle, this does not happen all the time, but when it does happen, it is extremely high probability. If the OTE allows price to retrace into the 1 a.m. candle, 1 a.m. hourly candle, then you have a high probability entry. Study what happens with price when exactly what I said occurs. If London supplies you with the right info, then the OTE will give you the highest probability trade of the daily candle. Trading the OTE is more high probability than trading at London. Why? Because the market structure shift has already occurred. You are trading alongside order flow. If there is an expansion leg that broke market structure, then it is very likely that the second expansion leg is at least the same size. All right, so what does this mean? This means that if market structure has been broken and we have the OTE, then the expansion leg that the OTE will produce will be at minimum the same size of the expansion leg number 1. Taking a look at an example here. Before actually getting into this example, I want to just explain the procedure on how you should be executing the Wednesday model. I want to make sure that I did not lose any of you here. So step 1 is, of course, to determine the higher time frame directional bias. This includes narrative. If candle number 2, in this case, we're looking at a daily time frame. This is Monday, this is Tuesday, this is Wednesday, all separated by these gray vertical lines. Monday, Tuesday, Wednesday. As you can see, Tuesday turtle souped Monday's arranged low. Price opens here and closes here. Price closes inside of Monday's range. All right. So this is candle number 2, this is candle number 3, and this is candle number 1. If candle number 2 has taken the low of candle number 1 and has not closed below the low of candle number 1, then there is a high chance that price will retrace to the 50% of candle number 1, aka Monday, and 100% of candle number 1. Okay? So if Tuesday turtle soups Monday's range and closes back into Monday's range, Then Wednesday will have a high probability of targeting the 50% of Tuesday's range, and then the high, of Monday's range, and then the high of Monday's range. By this time, this knowledge should be basic. This, by definition, is a 3-candle model. This is the Monday model that I have explained in yesterday's lecture. The only reason we are referring to this model that I introduced today as the Wednesday model is because I am teaching you where your entries will occur on a classic Wednesday buy day or sell day. Candle number 1 is Monday, candle number 2 is Tuesday, and candle number 3 is Wednesday. Candle number 1 and 2 give you the directional bias for Wednesday. Pair this with the fact that Wednesday has a high chance of being a classic buy or sell candle in the direction of weekly and daily order flow. This in itself gives you an opportunity for a high probability potential trade. Now, moving on to step 2 of the procedure. Map out the opening time and a range low and high of the previous candle. Before Wednesday opens, we must realize that every midnight is a new opportunity. Step number 3. Observe what unfolds. So on Wednesday, the 1 a.m. candle produces the low, and the 9 a.m. candle produces the OTE, the second protraction. The way price moves is through consolidation, expansion, retracement, also known as consolidation number 2, and expansion number 2. So we have 2 periods of consolidation, 2 protractions, and 2 expansions, 2 distributions. After the market structure shift, there is a very high chance for the second expansion leg to occur. The high that caused the turtle soup is broken through with a massive expansion wave. This is the market structure shift. When you see displacement past the high that caused the turtle soup. Displacement, quick displacement past the high that caused the turtle soup. You know, first off, that is a market structure shift, and secondly, a retracement is likely to follow suit, and expansion leg number 2 will occur. When the daily high and low is formed on the 15-minute time frame, you will find a range being souped at the high or low of it. So we have a range formed right here, equal lows on a 15-minute time frame with a range high, equal lows. We are turtle souping the range low at a key level. Turtle soup. And then expanding, breaking market structure, causing a second retracement, and so on. This example right here is a classic Monday low to high model. Now, Romeo will call this a Monday low to high model. I refer to this as a Monday model. Very, very basic. Why? Because Monday's low or high is going to be souped, and Tuesday and Wednesday will push prices to the high of Monday's range. This in itself is an entire model. Tuesday takes out the low of Monday. It does not break below the low. This is seen and understood when looking at price and not being able to see many closes below the range. This means that there is a lack of intention to move prices lower. Smart money does not want to move prices any lower than where it is. Pair this with a key level and you have a reversal point. Therefore, we can safely assume, after the fact that Tuesday closes back into Monday's range, we can safely assume that Wednesday will take out Monday's high or even Thursday. Thursday, of course, will occur if there is a news event which will restrict Wednesday's price action to reach Monday's high. Thursday will be the day to take out the high. Wednesday in this example is a classic buy day. Price opens, consolidates, creates a 15-minute range, turtle soups the 15-minute range, hitting a key level, expansion leg number 1, market structure shift, retracement, and expansion leg number 2. Turtle soup occurring at 9 a.m. and turtle soup occurring during 9 a.m. Sorry, did I say 9 a.m. here? I meant to say 1 a.m. and 9 a.m. If you only focus on catching 4 classic Wednesday buy days a month, you will become much more successful at what you do. Now, as I said at the beginning of this video, of the beginning of this lecture, Wednesday will not always have a classic buy or sell day. But when it does, you need to execute it. Do not stand by. Do not question yourself. Many people, many traders fall victim to not seeing the Wednesday buy model 1 week. So the next week when it should perform, they stand off and they tell themselves, it didn't work last week, so it will not work this week. If you fall victim to this way of thinking, you will not make it. You will not succeed. You need to accept the fact that there are different market profiles and every Wednesday will not move the same. However, better use of words would be to look for the profile that you are most comfortable executing. And when you find that profile, execute on it. And that is it for today's lecture. Very straightforward model. Okay, this is not a complex model. There is very minimal things actually occurring in this model. We talked about the higher time frame, the daily time frame, and we also moved down to a 15-minute and a 5-minute. We spoke about how to determine the higher time frame order flow if you want to catch the Wednesday's buy candle or sell candle. In this case, it's a buy candle. And we also spoke about how to actually enter these trades. What times to be looking for your entry. With that being said, the chapter is done. So chapter 4 is complete. I just want to add something into this lecture here. I am going to be releasing a YouTube video. This YouTube video will include chart work and not a slideshow. The YouTube lecture will be explaining the 5 a.m. model that I have already released to you guys. I am giving away the 5 a.m. model to the free YouTube students. So, if you are struggling with the 5 a.m. model, I recommend everyone go watch my newest YouTube video when it is going to be uploaded, likely tomorrow. When it is uploaded, go watch it, and trust me, you will not regret it. I am putting a lot of effort into this video. Less than a slideshow, however, I am still putting a lot of effort. We are diving into the charts. Well, I will be I will be diving into the charts in the next YouTube lecture. So if you wanted more back tests, that's going to be the video for you. If you wanted a deeper understanding of where to find the entry for the 5 a.m. model, then tomorrow's video is for you. If you just want a better understanding of the 5 a.m. model, then tomorrow's lecture is for you. Anyways, I appreciate you guys for tuning in. I hope everyone has been taking notes. And with that being said, let's get back to the charts and go ahead and backtest and study everything that you have learned so far. Have a nice one, and we will chat soon.